Hi everyone. Today we are going to be starting on Chapter 19, continuing with our pricing unit. Chapter 19 is all about pricing strategies. For 19.1, we're specifically going to be focusing on the importance of price. So by the end of this lesson, you'll be able to describe business pricing objectives and explain why the break-even point is important when pricing products. Our key terms are pricing objective, volume pricing, gross profit, return on investment, net profit, total assets, return on marketing investment, and break-even point. So before we really dive into the content, there's a couple of terms that we need to be familiar with. The first is gross profit, and this is the amount of profit before subtracting the costs of doing business. So basically all of your revenue. If you have a job and you get a paycheck and you see on that paycheck it says gross pay, that's like the pay that you get before taxes are taken out. So not actually your take-home pay. This is the same idea with gross profit. It's not your actual profit, it's the profit before the expenses are subtracted. The net profit is what's left over after all company expenses are subtracted from the total revenue. On the same line, if you have a job and you look at your paycheck and it says net pay, that's the amount that you're actually taking home. The same concept applies here. Terms to know also includes total assets. Assets are everything the company owns that's of value. If you've taken accounting, you should be familiar with assets, but examples are cash, supplies, your petty cash, different office equipment, materials used to manufacture. Those are all examples of assets. A marketing investment is very important, specifically to marketers. That's the dollars spent on a marketing campaign. It's important to know how much money you're investing into a campaign so that you can analyze your spending and make sure that your marketing investment is having an impact on your net profit. So the first thing that we're going to really dive into today is pricing objectives. So pricing objectives are the goals defined in the business and marketing plans for the overall pricing policies of the company. When you price a product, it should align with your pricing objectives. So it shouldn't just be an arbitrary number that you're choosing. You should have objectives and your pricing should align with those objectives. Pricing objectives should be revised regularly. Why? Because the climate changes and therefore you may need to change the way that you're pricing your products or services. Also, prices must be low enough to encourage sales but high enough to generate profits. You don't want your price to be so low that you're not making any money but so high that people don't want to buy your product. And there's two different categories of pricing objectives that we're going to dive into. The first is maximizing sales and the second is maximizing profit. So maximizing sales is a pricing objective based on offering the lowest price possible to get the largest number of customers to buy the product. Here, you're really focusing on increasing your market share, and your market share is the percentage of total sales in a market held by one business. Volume pricing is lowering the list price based on the higher number of units purchased at the same time to increase sales. So this kind of aligns with bulk purchases. The more that you buy, the lower each price per item is going to be, and that would therefore increase your market share. So if you look at this volume pricing example at the bottom here, it shows that the number purchased, it starts at 10. The price per item goes up to $12.999. And the total sales would be $9.99. However, if you were to buy 30 of that product, the the price per item would be $8.99. So the total sales would be a lot more, but you're offering a savings per item. And then it grows. So if you were to purchase 100 items, they would each be cost between they would cost $7.99 each. So the total sales would be $799, which is a significant amount more in total sales. And it's a benefit to the consumer because they're saving $200 in total by purchasing in bulk. Now, maximizing profit is a pricing objective to generate as much revenue as possible in relation to total cost. So the goal here is to basically make more on each individual item. So here we have something called the return on investment, and that's a measure of profitability based on the amount earned from the investment made in the business. This is a calculation that you need to do in order to determine if you're being effective or not. So, and if you're getting a good return on your investment. So in order to figure out this amount, you would take your net profit after taxes and divide that by total assets. There's also a term called return on marketing investment, and that's a measurement showing the overall effectiveness of a marketing campaign or yearly budget. This is especially important to marketers to measure their effectiveness. So in order to do this calculation, you would take your gross profit, you would subtract your marketing investment, and then divide that by your total marketing investment. And again, that gives you your return on marketing investment. We also have another calculation that you need to do, and that's the break-even point. The break-even point is when a product starts to make profit, and when the revenue from sales equals the cost, where everything after that would be profit. So the break-even point is often expressed as the number of items that must be sold to recover the money that you put out. And so in order to do this calculation, you would take the cost, multiply it by the number of units, and then divide that by the selling price. This is really important for marketers to calculate so that they can price their products correctly, forecast sales, and estimate potential profit. For today's activity, what we're going to be doing is we are going to be determining the break-even point for products based on different costs per unit. So you can see here today's activity, it says the break-even point is the point at which revenue from sales equals cost of selling the products. At this point, the company is not losing or making money. This is known as breaking even. Once the break-even point is reached, all the additional revenue is profit. The number of items that must be sold to break even can be calculated. The break-even formula for retail situation follows. So it would be cost per unit, multiply that by number of units purchased, and divide that by selling price. That will give you the break-even point. So here you can see the first example. The cost per unit is $2.50. You would multiply that by the number of units purchased, and that would give you 250. Then what you would do would be to divide 250 by $5, and that will give you the break-even point of 50. So that's the number of units that must be sold.